Okay, what if I told you that the one investment strategy almost everyone thinks is a brake pedal is actually a turbocharger for your wealth? Today, we're going to flip the whole script on diversification. We'll show you how playing it safe is actually the secret to winning the long game.
Right, let's just start with a gut punch. Seriously, read that again. Imagine waking up one morning and half of your hard-earned money is just gone. This isn't some made-up scare tactic. It's a real, devastating possibility if you've put all your eggs in one basket, no matter how solid that basket seems.
And this chart right here just lays it all out. Look at the left. That's the undiversified portfolio, a 50% loss. That means you need a 100% gain just to get back to where you started. A huge climb. But now look at the right. The diversified portfolio takes a hit for sure, but it's a manageable dip, not a complete wipeout. It's the difference between a setback and a total knockout. So this brings us to this huge myth that holds so many investors back. The idea that diversification is this boring, slow strategy only for people who are too scared to really be in the market. Well, let's tackle that one head on. This is the absolute heart of our conversation today. On one side, you have what most people believe, that you're just trading away big, exciting returns for a little bit of safety. But the hidden truth, the real story, it's that by preventing those massive portfolio-killing losses, diversification is what allows the magic of compounding to just run wild without getting constantly reset to zero. It's not a brake pedal, it's the turbocharger. So how does this turbocharger actually work? Let's pop the hood and really get into the mechanics of how spreading out your investments keeps your wealth creation engine running smoothly. First off, let's get a quick, super clear definition on the table. Real diversification isn't just buying, say, 2 different tech stocks and calling it a day. No, it's about strategically putting your money across fundamentally different kinds of investments. We're talking different asset classes, different business sectors, even different countries. And you can see here, it's all held up by these pillars. You need a mix of asset classes, like equity, which is your engine for growth, and debt, which gives you stability. Then you need a spread of sectors, so a bad year for banking doesn't sink your whole ship. And finally, you need that geographic spread, so a crisis in one country doesn't grind your entire portfolio to a halt. Each one of these pillars has a critical job to do. All right, so let's get practical. Let's see how this all comes together to build a much smoother highway for your money, allowing that compounding to just keep chugging along day after day, year after year without those horrible interruptions. Let's make this really, really real. Think back to the 2020 crash. Some portfolios that were all in on one thing saw drawdowns, that's the drop from the highest point to the lowest, of a whopping 50%. That's the kind of shock that makes people panic. It makes them sell at the absolute worst possible moment, locking in those life-changing losses for good. So how do you avoid that panic? Well, you build a team where every single asset has a specific role to play. Look at this breakdown. Equity is your star player, your growth engine, shooting for those big long-term returns. Debt is your defense, your stabilizer. That 7% doesn't look as sexy, but it's the rock that holds firm when everything else is shaking. And then you've got gold as your hedge. It often zigs when the market zags. It's not about finding one superstar. It's about building a championship team. A classic way to see this in action is the old 60-40 strategy. That's 60% in equities, 40% in debt. Now, when the market is booming, that 60% equity part is just firing on all cylinders, right? It's capturing all that amazing upside and really driving your portfolio's growth. But here's the genius part. When the market inevitably takes a downturn, yeah, your equities are probably down. But that solid 40% in debt, it's stable. It's preserving your capital. And even better, it acts like dry powder. It's cash on the sidelines ready for you to buy up more of those great equities when they're on a massive sale. That's what really accelerates your future compounding. And you can extend this protection even further. Investing globally helps shield you from problems in any single country's economy. And investing in broad index funds means that if one hot sector suddenly crashes and burns, the rest of your engine just keeps on running, pushing your portfolio forward. Okay, that's enough theory for now. Let's make this personal. I really want you to take a second and think about your own investments as we run through these next few questions. So ask yourself this, honestly. When you look at your portfolio's performance, does it feel like a thrilling but terrifying roller coaster with these crazy highs and nauseating drops? Or does it feel more like you're traveling on a smooth, steady highway, making reliable progress? That feeling, it tells you almost everything you need to know. And here's a tough one. We all have that one sector or stock we think is a sure bet. But just what if? What if the unthinkable happens and it just tanks? Does your entire 20-year financial plan go down with it? And finally, think about it like this. Do you have a full team of assets working for you? Do you have those defensive players, the debt, the gold, quietly doing their job, compounding in the background, ready to step up and protect your wealth when your star players are having a bad day? Okay, so let's bring all of this home. Let's boil it all down to the single most important idea you should take away from this. This is the ultimate goal. Listen, the point here isn't to get rid of risk. You can't. That's impossible. The goal is to manage it. And the whole reason you manage risk is to protect your compounding engine, to let it run smoothly without interruption for decades. Because that steady, uninterrupted hum, that is the sound of real, lasting wealth being built. So let's end on this one thought. A market crash for someone who isn't diversified is a disaster, plain and simple. But for the diversified investor, it's an opportunity. It's a chance to rebalance, to buy incredible assets at a huge discount, and to set the stage for the next powerful wave of uninterrupted growth. And that is the real superpower of diversification.